There are really two things that are going to put a hard stop and make it impossible for you to get an IUL or an Index Universal Life policy. But even if it is possible for you, right, technically to get an IUL, it may not be the best financial move for you. And so in this video, I'm going to walk you through not only what makes it possible for you to get an IUL, but also the three questions that you want to think through and reflect on so you can figure out if it makes sense for you to get the IUL based on those things that are really going to either restrict or fuel your Index Universal Life policy. If this is the first time that we are meeting, my name is Nobu. I'm a licensed financial strategist, and I help working professionals 40 and over save smarter and pay less taxes by using life insurance strategically. If you'd like to work with me, link is in the comments. Now, it is important to remember that an IUL is a life insurance policy, and as it is life insurance, you are not entitled to get it. Essentially, there is an application process and there are standards that each company has as to who they want to insure. Each company dictates what its rules are and stipulations to get insured by them. And one of those stipulations is age. So there is a cap to the age that you can be to get an IUL. Different insurance carriers have different limits, but the oldest that you can be is 85, again, depending on the specific life insurance company. So as long as you're 85 or younger, technically you can get an IUL. Now, the second major factor that's going to determine whether or not you can get an IUL is your health. Think of life insurance like gambling, essentially. What the insurance company is looking at is, okay, if we insure this person, is this person going to live for a long time? So we lessen the possibility of us, the life insurance company, losing. Because life insurance is essentially a contract. So the insurance company and you are agreeing to a contract that as long as you are paying your premiums, they're going to live up to their end of the bargain. One major end of that bargain is that as soon as your policy starts, if you pass away, even the very next day, they have to pay out the full insurance coverage. So you can make one payment for $500, and if that policy amount is for $500K, that life insurance company is obligated to pay that full $500K, even though you just paid $500. As a result, when they are considering who they want to insure, they are not going to insure people that have a higher likelihood based on their math of passing away sooner. There are certain things, certain diseases, certain medications, certain situations medically, where if you have any of these diagnoses, it is going to be an automatic no for an Index Universal Life policy. So for example, you could be 25 years old, but if you have certain medical conditions that carrier deems is a high risk, as in they deem that there is a high probability that you are not going to live a very long life, they are not going to insure you. And so even though you technically might be within the age range to get an IUL, you're not guaranteed that you can get it. It depends on what your health situation is. I'm also going to double back to age a little bit. So we have the technicality of just how old are you? And with that, it's also important to know that as you get older, your life insurance costs get more expensive as well. And so with an IUL, you're always paying for life insurance, and then you also have to pay above and beyond that life insurance to go into your cash bucket. So if all you can pay is just the life insurance, an IUL is not for you. So an IUL theoretically is going to be more expensive in terms of what you're putting in than a regular life insurance policy, because you always have to put that extra into your cash bucket. And so if you think about life insurance getting more expensive as you get older, the older that you are, the more you need to be able to put into it in order to make up for the fact that your life insurance is more expensive. It's important to keep that in mind because we're going to talk about it a little bit more when we talk about the things that are going to fuel or limit your IUL. Now, while age and health are two things that'll completely just take you out of the game completely, where if you're above the age or you have certain health conditions, you simply cannot get in. Two other things that are going to impact whether it's possible, but with these, it's just a time limit. First, your driving record. So if you have DUIs, DWIs, multiple accidents, multiple high-speed tickets, that is going to impact your ability to get an IUL, but it'll impact it for a specific amount of time till those things are over a certain age. Same thing with misdemeanors, felonies. If you have any of those in your recent past, that will make you ineligible for an IUL for a specific amount of time. So if you can technically get an IUL, right, your health is good, your age is in line, driving record is good, criminal record is pristine, the next thing you want to ask yourself, if you're like, okay, is it too late for me? Can I still do this? Are these three things that are different but intertwined. A lot of times people call and ask, should I get this? Is this a good idea for me? And I cannot tell you whether or not something is a good idea for you. I can ask you questions about what you're trying to accomplish, what you're trying to do, and then based on that, say, okay, yeah, you can do that thing or you cannot. But nobody knows the ins and outs of everything going on in your life. So it is important for you to be able to take a step back and make financial decisions for yourself based on everything you know about yourself, because nobody can see through your head. Nobody knows your whole story. So hopefully these three things will help you feel comfortable to take a step back and determine, does this product make sense for you? I'll go through each of them one by one, but you'll see how they all kind of interconnect in order to create this puzzle, which will help you figure out whether or not it's too late for you. And it's the same questions that I would ask you for you to figure this out for yourself. The first thing is just, what is your goal with this account? So this is a life insurance policy, yes, but you also have the added bonus of having this supercharged savings account attached to it. It's a supercharged savings account because the interest that you'll be getting in this account is a lot higher than what you'd be able to get in a bank account. And so the first question is, what are we doing here? So are you primarily opening this to have a life insurance policy? Are you primarily opening this because you want to use this for retirement? Are you primarily opening this because you want to be able to invest in real estate from this account? It's important to be clear on what is the goal for this account and have one main goal in order for you to figure out whether or not it's too late. It's because what your end goal is for this account is going to determine a few other things. It's also a very customizable account. And so if you're trying to do 10 different things with this account, you're gonna have an account that's not doing anything well. If you take a step back, even just with regular savings, most people that are serious about their savings have different checkings, different savings, just so they're clear on what's going to which account and they stay organized. For myself, I have multiple savings accounts depending on what the goal is. So I have a savings account that's specific for travel. So I know, okay, I want to take X amount of trips. So based on that, I'm putting X amount of dollars into this account. I have a separate savings account for my fun money. I have a separate savings account for funds that I give to my parents. So if I'm serious about wanting to be able to consistently go on a trip like every quarter, if I just have everything in a general savings bucket and then like somebody has a big wedding and I buy a big gift, well, then I can't go on my trip. Now, thinking about your IUL, because it has to be built out and customized for each person, if you're clear on what your end goal is, then you have a higher probability of this account being designed in a way that actually helps you to accomplish what you're trying to do. Next question is, what is your timeline? So, for example, if your goal is, I want to use this account to buy commercial buildings, then the next question is, well, when do you want to buy these commercial buildings? Are we trying to buy this commercial building next year? Or are we trying to buy this commercial building in 10 years? Because remember, as you're putting money into this IUL, part of your funds are going towards paying for your insurance. Part of your funds are going into your supercharged savings account. And so it's important for you to know, when do you want to start doing this thing? And so you have a realistic idea of whether or not you have the time to make that happen. And speaking of time, that is actually the third key fuel factor, which is either going to make your IUL be supercharged or limit what your IUL looks like. Part of what makes the IUL powerful is that as you're putting money into this savings bucket, you are getting a good amount of interest credited to that each year. And so the more that you have in that account, the more interest is going in, the more that your money starts to grow on itself and compound. So if you're thinking, okay, I want to see this money grow, that is going to require time. We're gonna keep this example of buying a commercial building. So if you want to buy a commercial building, and let's say you're somewhere that's not very expensive, and that commercial building is $500K, it's important for you to think through, okay, one, what is my goal? That's a commercial building. Two, what is my timeline? I want to buy that commercial building in 10 years. So if it's 500K, part of my money is going towards cash, part of it is going towards the insurance, then just logic, like how much do I need to put in here to be able to get 500K? And it's important to note that the money does not grow magically. What you can get out of it is directly related to how much you're putting in. And so if you are not putting in a significant amount of money that's going to lead to 500K in 10 years, then you're not going to be able to pull out 500K, right? So if your goal is, I want to buy a building for 500K, but I'm only going to be putting in $1,000 a month, it's not possible to get to 500K in 10 years. And so it's important to remember, like, what is my time to make this happen? What is my budget? Like, what is my money looking like? And then what is my goal, right? The time and your money are the two things that are either going to fuel your IUL or are going to limit it. And so whether or not it's too late depends on what are you trying to do exactly? What is your goal? What kind of time do you have? Like, do you have time for that money to grow? And two, what does your money look like? If you have time, that is good. There's more opportunity for you to get interest and for it to compound on itself. If you don't have time, then you have to have the money that matches what your goal is, right? So if your goal is, I want to be able to take out 10,000 next year, but you're only putting in 1,000 this year, it's not possible for you to take out 10,000. But if you're 20 and you're putting in 1,000, you want to take out 10,000 in 10 years, then there's a higher likelihood of that happening. The time, money, and goals all kind of intersect, but they also overlap with your age and your health, because one, the older that you are, the more expensive life insurance gets. Also, the less healthy you are, like the more things you have going on medically, even if you do get approved, it's also going to be more expensive. So keep in mind that you're always paying for insurance, and for this type of policy, you also have to put in more than just your insurance. If you actually want to see cash growing, the older that you are, the more of your cash is going towards paying for the insurance. So it's important to have a realistic understanding of what do these numbers look like and does my goal make sense? So if you are 60 and you're retiring in 5 years and you're saying, okay, I want to use this for retirement and I want to get $20,000 a year, if you're only putting in a couple $100 a month, that's not going to happen, because out of the couple $100 a month, you always have to pay for insurance. You always have to have cash. As you are older, your life insurance costs are more expensive. And so that $200 is not going to do a lot for you. Whereas if you're 20, you put in $200, you have the benefit of time. You also have the benefit of money, because as a 20-year-old, your life insurance is a lot cheaper. So if you're 50, 60, 70, asking yourself, is it too late for me to get an IUL? Check with yourself, like, what am I trying to do with this policy? Do I have the time to get to this goal? If I don't have the time, do I have the money? Because you got to have either time or money. If you have both, you're golden. Cash value life insurance is one of the most underrated vehicles to grow wealth and also to protect your money from taxes. And the sad part is that a lot of regular people just do not even know that these types of policies exist. I know for myself, I did not know that these were options until I actually got my life insurance license. And it wasn't even from the actual licensing part that I got a good understanding. It was from a conversation with another agent who really made me open my eyes to this. And so I'm not surprised that a lot of people just don't understand or know that, like, this is possible, because you don't know what you don't know, and you only know things based on what you are exposed to, right? So if everybody around us has an idea or has the belief that life insurance is only to leave money behind when you pass away, they don't understand that you can actually use life insurance while you're alive. Not only for the cash part, like there's multiple benefits that we're not going to go into like in this video specifically, but if you're not exposed to new people and new ideas, and you just are used to hearing the same conversations with the people around you, then you're not going to know about different ways or different opportunities that are out in the world. And this is one of them. So really with this channel, my goal is to bring the information out to like regular folks so you understand like life insurance is not just to leave money when you pass away. There's multiple ways to use life insurance while you're alive, and really to make it very simple and easy to understand so you can make a decision for yourself if this is a good fit for you that you want to move forward in adding to your portfolio, or if it's not. And so I love getting comments with questions or concerns that I'm able to address. So one, don't be shy to leave comments. I do read the comments. And sometimes it's just easier for me to make a video like this to respond to a comment rather than typing, because there's usually nuances to the response. And so it's easy to talk through it. And more importantly, if I talk through it, then you can better understand the mechanics and how things work in the policy. So you can kind of think through these questions yourself in a way and better understand how this works, right? Because if you don't understand how it works, then you're going to have a skewed belief on whether it's for you or whether it's not for you. So this comment was on a video where I was just explaining or talking through numbers on a policy. And JZK 2020 left a comment saying, you forgot to mention that if she stops paying or misses payments on her policy, it will lapse. So there's two parts to this, right? So first concern is like, will stopping payments cause your policy to lapse? And second concern is, will missing payments like cause a policy to lapse? So I'm going to talk through the stopping payments first. And so if we are getting an IUL and our goal is to primarily use it, right, for cash value, for the cash growth, then what that means is that IUL is going to be designed specifically to make that happen, right? So you can have an IUL where the primary goal is just the life insurance, right? And that's going to be built differently versus an IUL where we want to maximize and have as much cash growing as possible. And so this gentleman's concern, or maybe it's a lady, I don't know, is like, okay, well, if she stops paying into this and the policy is going to lapse. So you can absolutely get an IUL where you are paying money into it until the day that you pass away. Then it's probably for primarily a death benefit, right? Without seeing it. If you are getting an IUL and the goal is to grow cash, then it absolutely should have a date where you are going to stop putting payments in there. Whether that date is 7 years, 5 years, 10 years, 20, or more than that, it depends on how the policy is built out. But there absolutely should be a date where you are stopping to put payments in there. And the way that it works is that, remember, when you're getting an IUL, part of your funds are going towards the insurance, part of your funds are going towards your cash. So essentially, the funds that are going into the cash bucket, you are essentially paying for your insurance in advance. So an IUL is a permanent policy, so there will be a cost of insurance until the day that you pass away. But if we're building this out correctly, where we are maximizing our cash, then we should have so much money that's been built up from interest and so much money that continues to grow from interest that you start to have money available in your cash that's going to pay for your policy until the day that you pass away. So if you have a policy being built out where you have to, like, mandatory put funds in until the day that you pass away, it's probably not built out to maximize your cash, because you shouldn't have to do that, right? You should have enough funds in your cash bucket, enough funds that have grown from interest, enough future funds that are going to be growing from interest where you no longer have to put money in to pay for your policy. There is still a cost of your insurance that's going to be pulled out from your cash, but it shouldn't be coming out of your pocket if that policy has been built out correctly to maximize your cash growing. When we build these policies out, right, we are essentially like planning it out based on how much you're putting in for how much time. So if the plan says that you're gonna pay $500 for 20 years and you stop at year 10, then more likely than not, the policy is going to lapse. Now, it's not going to lapse right away, and I'm going to get into like why that is when I'm talking about the missed payments. So you want to stop paying into this at the time that you said you were going to stop paying into this. If you stop at a different time, then that is going to impact what happens with your policy. and more likely than not, it is going to lapse eventually. So to clarify that, right, you should be stopping your payments at a specific point, but you should stop that payment at the time that you said you would, at the time that this policy was built out, because the numbers that you're looking at, the probability of the policy like working well, is based on the plan that we put in place when we start this policy. Which is why it's really important to have your policy built out correctly from the beginning so that it functions properly and does what it's supposed to do and lasts until you pass away. I do have a checklist that you can use to make sure that your IUL is built out in order to maximize your cash growing, so you do not have to pay into it until the day that you pass away. Go ahead and drop the word checklist in the comments if you would like a copy of that. Let's go to the other part of the questions, which is missing payments. I want to just remind you that when you are getting an IUL that is designed specifically to focus on cash growth, a small amount of money goes towards paying for your insurance, a large amount of money goes towards your personal bank. So let's say you were putting in $10,000 a year, $2,000 is going towards your cost of insurance, and $8,000 is going in your personal bank. What that means is there is $8,000 available in your bank that the insurance company is going to tap into first before they actually shut down your policy, right? So if something happens, like you lose your job, your cost of insurance is $1,000 a month, but you have $10,000 in your personal bank, then you have a few years of leeway essentially where your policy can still keep going even though you are not paying into it, because the insurance company is going to start taking the actual minimum amount, the actual cost of insurance, in order to pay for your life insurance, right? Remember, you paying extra is because of the way that we designed it, right? We are using life insurance rules to our example to allow you to put in more money than you need to. On the part of the life insurance company, right, you don't have to put all the money in for your actual life insurance to be intact. It's important that you put in the money that you plan to, because the future of your policy rests on you putting the funds in the way that you're supposed to, because as you get older, your policy is going to get more expensive. And so we want to front load our funds ahead of time, just based on the way that these types of policies work, right? The way the policy works, your cost of insurance is based on how much is in your cash versus what your life insurance payout is. And so what we want to do is close the gap on that as quickly as possible before you get super older, so that your cost of insurance when you are older, when you're taking money out of your personal bank, is not going to be anything debilitating. And so can you miss payments and your policy will continue? Yes. Can you miss payments and your policy can lapse? Yes. It depends on how much is in your cash bucket and when you miss this payment exactly. So if you miss it on like the second month that you have this policy, then you're more likely to have a policy lapse if you didn't put a lot of money in to begin with, right? It's not going to lapse immediately because you're going to have some funds in there, but it's going to lapse pretty quickly. Whereas if you've had this policy for, 4 or 5 years and it is built for cash value, where more of your money is going towards cash, then you have a lot of cash that's in your personal bank that can cover you for a long period of time before your policy lapses. So it's important to remember that this does not work like a regular life insurance policy. Regular life insurance policy, you miss a payment, you're out. That's it. With this type of policy where we are front loading money, we're putting in more than we need to, we're covering more than the actual life insurance, then there is more leeway for you to miss, right, and adjust. But the longer you've had your policy, the more you've been putting into it, the less you have been playing with the numbers and putting in less than you should have, and the more flexibility you have to miss those payments or stop those payments and still have your policy work for you and not have a policy lapse. Generally, IULs are pretty forgiving in terms of missed payments or stop payments, in terms of keeping your policy going in the short term. But in terms of having a policy work well in the long term, I want to stress that it's really important to follow the plan that you have in place. You can always put in more. Putting in more than you plan for is perfectly fine. Putting in less that you plan for is going to cause you some problems down the line. And it's going to make it more likely that your policy is not going to work as well as it's supposed to. Your policy being built out correctly to begin with is important. Drop the word checklist if you want a copy of the checklist that you can look at to make sure that yours is being built out correctly. But also important on your part is to follow the plan like that was put in place when the policy was built in order for your policy to work well for you so you can save on taxes and have your money work hard for you. Maybe your friend, your mom, or maybe even a random person on Instagram has said that everybody needs to get an IUL. The reality is that an index universal life policy is absolutely not a great idea for everybody. There are plenty of reasons why an IUL may not be a good fit for you. I'm going to walk you through 5 signs that an IUL is not the best idea for you in this moment. But before we get into that, I am curious, who is it that told you about an IUL? Like, why do you want one? Go ahead and share that in the comments. If this is the first time that we are meeting, my name is Nobu Musakiwa. I'm a licensed financial strategist and I help working professionals 40 and over save smarter and pay less taxes by leveraging cash value life insurance like an IUL. If by the end of this video you feel like an IUL is for you, the link is in the comments to work with me. Before I get into reason number 1, I'm going to give you a little bit of context. There are a few ways that life insurance companies win. Way number 1 is when people get term life insurance policies. Term policies are super cheap for the customers and have a big payout, so it seems like it's a good deal. But the reality is that 98% of term policies get to their expiration date with the person still being alive. What that means that if you have a term policy for 10, 20, 30 years, you pay that whole time. At the end of that contract, you are still alive, which is a good thing. But also on the part of the life insurance company, it's a good thing for them because you never passed away. Second major way that life insurance companies win is if people don't keep their contract term on their permanent policies. Let's say you are approved for a policy, you're supposed to pay $300 a month until you pass away. You pay that $300 a month for 5 years and then things happen and then you stop. Essentially, the life insurance company is going to get to win because if you had kept paying, they would eventually have to pay out that insurance policy at the time of your death. But because you stop paying, they no longer have to continue with the contract because you did not live up to your end of the bargain. Which brings me to reason number 1 why you should not get an IUL is not having a specific use case for this policy. Because the reality is with an index universal life policy, this is a permanent policy. So it's going to require a long-term commitment in terms of a payment. And if you do not follow through on that long-term commitment, then you are going to essentially lose this policy. What I find is that with most things in life, if we have a reason why we're doing something, and if that reason is important, then we're going to actually stick to that thing. So if you just want to get this IUL because your friend said it's a good thing, if you're in some kind of financial bind the next year, the first thing that's going to go is the IUL because you don't have a specific use in mind for it in order to actually sacrifice keeping it. Whereas if you know that this policy is specifically for retirement funds, or this policy is specifically for my newborn so that when they're 35, there's $1 million in there, right? So if there's a real tangible and emotionally pulling reason as to why you are opening this IUL and why it makes sense for you to commit X amount of dollars for X amount of time, then the chances are higher that you are actually going to keep it long term. If you actually keep your policy long term, then you are winning because you have insurance in the event that you pass away soon. You are also winning in the event that you live long, which is what we want, because you also will have the ability to take cash out of that policy to leverage in other ways. Like I said, when you are getting an IUL, this is a long-term play. So sign number 2 that an IUL is not for you is if you are expecting this to be a get rich quick situation. I have a lot of people that call and they think, okay, I'm going to put in $200 on month 1 and then month 2 I can take out, $500. That is not how this type of policy works. An IUL or any cash value life insurance policy is very much a slow and steady play, especially if you're putting in funds on a monthly basis. If you're looking to get like a quick return on your money right away, then you probably want to look into trading and that kind of thing. Whereas this is more of like a slow and steady thing. So if you have had a brokerage account for a long period of time and you put money in consistently and you're comfortable with waiting, this is good for you, right? Or if you have a 401k that has a high balance because you have been consistent and patient with putting funds in, this is for you, right? If you have property that you've purchased and like you don't flip it, you like just chill and wait and see the value going up, then you are probably a good fit for an index universal life policy. If you're someone that is not patient, if you're someone that's going to be checking the balance every single day, if you're someone that's expecting to be able to put a little tiny amount in today and take out a whole bunch tomorrow, then this is not for you. This is very much slow, steady, chill, long-term play. So patience is very much needed. In addition to your returns being steady over a long period of time, there is also the fact that because you are leveraging a life insurance policy as a savings vehicle, the way that it works is you have to pay for your insurance and then you're actually putting in more money than what your insurance costs. So you have the ability to have that savings account or that personal bank attached to your life insurance. And so because of that, how much you're putting into this every month is going to be a lot higher than what you'd be putting in if you were just getting a regular life insurance policy. And so if your goal is, I want to get the cheapest life insurance policy possible, an index universal life policy is not a good fit for you because it's not going to be your cheapest option possible. Your cheapest life insurance possible is going to be life insurance that is just life insurance, versus if you're getting an IUL specifically designed for maximum cash value, then the idea is that you are paying in more than your regular insurance so that you can take advantage of those benefits that you get from having money in a life insurance policy. So if you're specifically leveraging an IUL to be able to use as a savings vehicle to take advantage of the benefits of having funds in life insurance, like having funds grow in there without having any capital gains tax, being able to take money out of there and not have it count as income tax, having access to the funds and essentially having your own personal banking system, and of course having the actual life insurance as well. So if you pass away soon, you have that life insurance that you leave behind, and that again is not going to be taxed. If that's the goal, we can't do that and just get a regular policy. So the caveat is that if you want to be able to take advantage of that and play that game, you got to be willing and be able to pay more for your life insurance. And if that pains you, if that doesn't work for you, then an IUL is not a good fit for you. Similarly to that, because we are growing our funds in a life insurance policy, you are always going to have the cost of life insurance. And because it is a life insurance policy, there's also going to be fees along with that. If you are super concerned with what is the fees, like what are the costs, and trying to do all this math to get the cheapest fees possible, then an IUL is probably not a good fit for you because you're thinking more of like, what is this going to cost me, which is more of a broke mindset, versus looking at it as what is this going to gain me. So instead of looking at, okay, like what are all these different fees, just looking at the bigger picture of, okay, I'm going to put in 250K and I can pull out 1.7 million. So that makes sense to me. That's more of an IUL type person who has more of a wealthy person mindset. But if your mindset is how much is it going to cost me and worrying about the cost itself versus your outcome, this is probably not a good product for you, babes. And sometimes you're concerned with costs and fees because you are not in a financially stable position. And if you're not financially stable, that is a big sign that an IUL is not a good fit for you. As I said earlier, this is a long-term commitment and this requires putting funds over a long period of time or putting large amounts of money over a shorter period of time. But either way, it does require financial commitment. And if you're in a place right now where you're not able to pay your basic bills, then an insurance policy where you have to pay more than just the basic insurance costs and also do that over a long period of time is not a financially sound move if you don't have the basics in place. So if you're not saving regularly, if you don't know what's happening with your money, if you're behind on bills, you're living paycheck to paycheck, like you are not organized with your funds, you want to get a routine and get a system in place where you are saving regularly, you are on top of your funds, you are financially stable. Once you have that in place, then you can add in a cash value life insurance policy. Doesn't mean that you should not get life insurance or life insurance is not a good idea. It's probably a good idea to get something cheaper and something that you are not overfunding like you would with a cash value policy first. Once you're stable, then you can transition to a custom designed cash value policy like an IUL where you are actually able to leverage your funds and have them grow for you faster. Getting an IUL when you are not financially stable is like you trying to run a marathon when you can't even run a mile, right? You first have to be able to do that 1 mile and do that 1 mile consistently, and then build your way up to get to the marathon. So get your finances in place, get that in order, and then look into your custom designed IUL. And a bonus sign that an IUL may not be a good fit for you is if you are a DIYer and you're trying to figure out how to do this on your own. Unfortunately, if you want to get an IUL that is custom designed for you to maximize the cash value in it, you are not able to do it on your own. An IUL specialist has to actually create the policy for you. They're going to take a policy and do some adjustments so that essentially more of your funds are going into a separate cash bucket as opposed to an actual life insurance policy. Whereas if you do it on your own, you don't have the toggles necessary, if you will, to make those adjustments. You'll just have a click and play basic policy, which is not going to maximize your ability to actually grow cash in that policy. So if you want an IUL for cash growth, you have to work with somebody. If you're determined to DIY it, you're going to end up with a regular policy that you think is doing the same thing for you, but it really isn't. Because an index universal life policy is custom designed for each person, when the question comes up of what is the minimum amount that I need to start a policy, that answer could vary wildly from person to person. And in this video, I'm going to walk you through the 5 core things that are going to impact what that minimum amount is, so you have an idea of what your minimum is based on what you're trying to do with this IUL. If this is the first time that we are meeting, my name is Nobu Musikiwa. I am a licensed financial strategist. I help working professionals 40 and over save smarter and pay less taxes by leveraging cash value life insurance. The first thing that's going to impact how much you need to start an IUL is going to be which company you are applying with. Every single life insurance company has their own standards for what the minimum policy is that they're willing to open for each individual. There are some companies that will open a life insurance policy for $5,000. There are some companies that will not take the time to open a life insurance unless you have at least $100,000 policy with them. And even within the realm of an IUL, in that same company, there could be multiple IUL products where there are different minimums. Where one product, the minimum insurance is $100,000, and for another product, the minimum insurance coverage is $1 million. However much insurance you're getting is going to determine how much you have to pay for insurance, right? So just without knowing specific numbers, it's logical that if you're paying for $50,000 worth of insurance, your cost is going to be a lot different versus if you're paying for $1 million worth of insurance. And so if you open a policy with a company where the minimum is $50,000 versus if you open a company where the minimum is $100,000, the minimum that you're going to need to get started is going to be different depending on what company you are applying with. This is why, among many other reasons, it's helpful to work with an insurance agent or an insurance broker like myself who primarily focuses on IULs, because if you tell us how much it is that you actually can put in, because we do this every single day, because we're familiar with multiple companies, we can easily point you to the correct company based on your budget, as opposed to you trying to go crazy figuring it out on your own. Now, in addition to the minimums impacting your cost of insurance, another huge thing that people just really don't understand and downplay the impact of when it comes to life insurance cost is age. When a life insurance company is considering your application, what they're thinking through is what is the likelihood of this person living long. If they're living long, we want to insure them. If there's a high probability that they don't have a long time to live, then we don't want to insure this person. And so the older you are, right, the closer you are to your expiration date. And so as a result, the older you are, the more expensive life insurance gets, because it's a bigger risk for the insurance company to put insurance on you, because there's a good chance that they're going to have to pay out because you are closer to your date of death. When you're thinking about your age and life insurance and how it impacts how much you're going to pay exactly, think of the average life expectancy in the US, right? Which I think is around 78 currently. The closer you are to that average life expectancy, the more expensive your insurance is going to be. And the further away you are from that, the cheaper it's going to be. So if getting insurance for a 2-month-old, a 2-month-old has a long way to get to 78. And so that insurance is going to be cheaper. Looking for a 25-year-old. Again, they're pretty far away from 78, so that's going to be cheaper. Once you get to 40, 50, 60, like we're getting a lot closer to 78. And so you are going to be paying a lot more than if you had gotten this policy when you were younger. Along the lines with age, something that's going to impact your life expectancy is your gender. The life expectancy of males is lower than women, and so the cost of insurance for a man is going to be higher than the cost of insurance for a woman. So you could have the same exact birthday as your spouse, but because they are an opposite gender of yours, they are not going to have the same insurance costs as you. So your gender is also going to impact what your minimum is that you need to put into an IUL. Keeping track with this risk thing, something else that's going to impact what your minimum is that you need to put in is going to be your health. If there are things going on with your health that make it where you are a riskier risk, so you are overweight, you smoke, you have diabetes, you have high blood pressure, like while these things are not like things that are going to make it where you pass away tomorrow, statistically, if you have these things going on, then your life expectancy is lower than someone who does not have these things. So insurance company have different ratings where, if you're super healthy, insurance is this amount. If you are a little bit less healthy, insurance is a little bit higher. And then like if there's things that are very worrisome, but they're still willing to accept you, then like insurance is even higher. And so just because you have diabetes doesn't mean that you're not going to be able to get a policy, but depending on how controlled your diabetes is, you might have to pay a little bit more for insurance versus if you don't. And so that is going to impact what the minimum amount is that you are going to need to start your policy. Arguably, the most important factor that's going to determine what your minimum is going to need to be in order for you to start this IUL is going to be what you actually plan on doing with this policy. And speaking about that, let me know in the comments what you are trying to do with this policy. So like I said, an IUL is customizable. And the first question we're going to ask you to figure out what the minimum you need is, in combination with the other things that I mentioned already, is the primary goal for this IUL to simply have a life insurance policy that covers you at the time of death? Like, is that the main goal, to simply have life insurance? Or is the main goal to use this to be able to take cash out? If the prime goal is life insurance, you're gonna have a different minimum of what you can put in there and have the policy work to have just a regular life insurance policy. If your goal is you want to use this policy essentially as a bank where you can take money out and put money back in and leverage that money to do other things outside, then there is a different minimum that you are going to need to get this policy started. If your answer is that it is cash, the next question is like, when do you need to take this cash out? You want to look at how much you want to be able to take out, and you got to put more than that upfront. So for example, if your goal is to start a policy and take out $100,000 in the first 60 to 90 days of the policy, then you need to put in more than that $100,000 in order to be able to make that happen and take it out essentially immediately. So if you're not planning on putting in 100K plus and then taking that out to invest elsewhere, there's all these different factors what determine the minimum amount that you need to open an account. How do you figure out what the minimum amount is for you? The best way for you to do this and not drive yourself crazy is to not worry about the moving pieces of which company has the smaller policy, which company charges what. That doesn't really matter. What actually matters is what you can reasonably put in for a long period of time. Take a step back and ask yourself, what is a comfortable amount that you can put in consistently for a long period of time? Once you have that number, then have a conversation with an IUL specialist who can tell you what that will do for you. If you have been researching cash value life insurance policies like an IUL and you're having a hard time just figuring out how much money is going to go towards the insurance versus the cash, in this video, I'm going to walk you through why there is no cut and dry answer to that and why you are going to have to sit and talk with somebody to build out an IUL to get the answer to that. And also why you keep hearing about structure and how the structure actually impacts the question that you have of how much is my insurance going to cost versus how much am I going to make. If this is your first time here, welcome. My name is Nobu. I help working professionals 40 and over Save smarter and pay less taxes by leveraging the benefits of cash value life insurance. If you want to work with me, the link to do so is in the description. Now, I'm going to share some numbers and specifics from a few policy designs, but before we get into that, we need to first level set on just two core tenets of an IUL. Tenet number one that's important to understand in order for us to get an understanding of this is just that an IUL is built from scratch. Think of building a house where you go and all you see is land, right? That is an IUL. When you're working with an insurance agent or an insurance broker like myself, when we're going to build out your IUL, if it is a true custom designed IUL, there is absolutely nothing there. We have to go in and build everything out step by step, and that is going to be built out depending on what you are trying to accomplish. If we're thinking about this the same as building a house, right? We're going in and there is land. Your agent or your broker is your architect. So we are going to do a design for you, and that design is going to go to the insurance carrier, and that design has to be approved. Same way as if you're building a house, you have to get an architect. You're going to tell the architect what your vision is, what your dream is, how many bedrooms you want, if you want a pool. The architect is going to put a design together for you. Then that goes to the city, and the city says yes or no. And once they say yes or no, then you go ahead and you start putting your house together. A lot of times when there's question marks, people forget that an IUL is designed from scratch for every single person. So there is no one size fits all answer. It's going to be dependent based on our land, based on your vision, and based on the design. Tenet number two is if we are using this IUL in order for us to leverage, to save on taxes and have our money grow faster, when we're designing it, we are not putting all our money towards insurance, right? We are overpaying for insurance. So if our insurance is $200, we're going to put $1,000, which means that we have more money going into our personal bank. And now the part that can be confusing is how do we determine what the cost of insurance is? That's going to be determined by how much insurance that you are getting, which is going to be determined by your design, right? And as we are building this policy out, there are certain rules that we need to follow and need to adhere that's based on IRS guidelines that are going to determine what our minimum is and our maximum is and how much insurance you have to get in order to make this happen. And that's where this part of the structure is going to come up, because there is no one size fits all structure for an IUL. Similar to if we have a neighborhood of brand new houses, every single house is not going to be the same, right? Even though you might have the same amount of land allotted to you, what your house actually looks like depends on what you told your architect, what your dream is, what your budget is, and what the city approved in order for you to be able to actually build on that piece of land. So if you're working with someone and you're asking questions about an IUL and they're telling you that it depends, they're not being a jerk. It really does depend on your age, what you're trying to do, what your budget is, what insurance carrier you end up going with. All those things determine what your IUL actually looks like and what your potential outcomes are from that policy. Now, the main question mark that prompted this video was a question of, okay, how much money is going towards insurance versus how much is going towards my cash? I'm going to walk through some basic numbers on 3 different policy designs. Now, we're going to assume that this is a male, 40 years old, in good health, and the budget is $1,000 a month. Are we tracking? Cool. We're going to start with looking at a foundation design. This is a pretty standard design. Most agents that focus on IULs know how to do this. And the goal of this type of design is to ensure that by the time retirement comes, there is a large amount of cash that is available that can then be used as supplemental income. And so we're putting in as much as possible over a long period of time to make sure that our cash bucket, our personal bank, at the time that we start taking money out, is pretty significant. So with this particular design, this gentleman, 40 years old, will be putting in $1,000 a month for 25 years. The permanent life insurance for this type of design at the time that this policy starts would be about $620,000. The initial cost of that insurance will be about $3,500. So out of $12,000 a year, $3,500 will be the cost of insurance. And then all the rest of the money will be going into the cash bucket, into the personal bank. That's the amount that's going to be growing interest based on stock market performance. And that's going to be the cash where whenever he starts to pull cash out, those funds are not subject to income tax. They're not subject to capital gains tax. In this particular design, in year one, how much you can actually take out of the policy is $0. So you will not be able to take cash out of this policy in year one. There is money that is getting interest, but he does not have access to take cash out. Let's also look at year five. At year five, he'll have access to about $37,000 in cash that he can take out. And then at age 65, $615,000. Well, I want to just add a caveat that these are all hypotheticals. These numbers are not guaranteed numbers. The actual cash available will be dependent on the actual stock market performance, because that is what determines the interest in these accounts, right? And so with this foundation design, over that 25 years, you would have put in $312,000, and the amount available at age 65 would be $615,000. But the main question is like, what's the cash versus the insurance? So about with this foundation design, about $3,500 going towards the insurance, and then the rest going towards cash. Now, this design is great for someone who wants to have as much funds as possible later down the line, and they don't mind putting in money over a long period of time and is comfortable that they can consistently do that over a long period of time. Design number 2 is an accelerated design. Again, still male, 40 years old, putting $1,000 every single month as a budget. But this time, the insurance amount is $370,000. And the timeline to pay into this is 10 years. So after 10 years, they will not be able to put any more cash in. And the reason why that is, the insurance amount determines how much you can put in and 10 years. And once they hit that 10-year mark, they will not be able to put anything into this policy for another 7 years. And this is just based on IRS rules, where after you've hit a certain number based on what your insurance amount, you cannot go over that. Otherwise, you will be taxed. So just based on those rules, the max that can be put into this policy initially is $115,000 over that 10-year period. Now, the cost of insurance, which is a big question, right, would be about $2,000 in this case. So remember, case number 1, we still were putting $1,000 a month, $12,000 total for the year. Cost of insurance was $3,500. In this case, we are still putting $1,000 a month, but instead our cost of insurance is $2,000, $190. And the major reason why there is a difference in that is the structure. How much is putting in per month is still the same. The structure, though, is different based on the goals. With this accelerator structure, cash in year 1 will be $2,285 that you actually can take out. Year 5, there'll be $48,000 you'll be able to take out, and at age 65, $342,000. Total amount put into the policy, $115K, and hypothetical amount to take out at age 65, $342,000. So the major difference in this is that the commitment, the time commitment to put money into this is a short amount of time. So it's 10 years, but because you're putting in less money, then there also is less in total available for you to take out at those later years. And so this is perfect for someone who wants some extra cash for later, but also doesn't want to be locked into a payment for 20 years, right? So if you ask somebody, can you put $1,000 a month for 25 years? Some people may not be comfortable for that, but they might be comfortable with $1,000 for 10 years and then just letting that sit and write out and have cash available for later. An important thing to know when I'm talking about the cost of insurance, this cost of insurance is specific to this particular company that I looked at these numbers in. It is specific to the state that this person lives in. It is specific to them being a male, being 40, being in good health, right? Also, the numbers are specific to how I designed this policy. And there are a myriad of ways to design policies. And so if you talk to someone and this is not the number that they gave you, if they're not looking at the specific company, if it's not designed the specific way that I designed it, then that's where you're going to have a discrepancy in different numbers, right? This is just to give you an idea and get your head rolling. But in order for you to understand what your options are for you, you would need to actually talk to somebody, get something designed, and more importantly, actually get it approved. Because what your actual cost of insurance is going to be is only going to be determined once the insurance carrier has actually processed your application. When you're looking at illustrations, when you're getting hypotheticals, it's just an estimate based on best case scenario, but your actual cost of insurance depends on what you actually get approved for. Looking at our next design, this is a bridge design. Still 40-year-old male in good health, $1,000 a month is the budget. I'm keeping it the same amount per month on purpose so that you can see like the difference in performance of the policy depending on what the structure looks like. So with this bridge design, the insurance amount, the permanent insurance is $183,000. And the timeline to pay this $8,000 a month is 8 years. And in that 8 years, he would have put in about $92,000. In this case, the cost of insurance is around $2,000 again, same as the 10-year policy. Now, you might be wondering, well, why is this around the same price as the other policy when there's actually less insurance in this? And now, with this particular design, there is the permanent insurance on this. And at the end of that 10-year period, this person has the ability to open another IUL for $180,000 without having to go through any underwriting. So essentially, they are guaranteed to get another policy even if they have had events that would normally deem them ineligible to get a policy. So if they get a heart attack, stroke, cancer, with this particular bridge policy, it doesn't matter. They will still be able to open another IUL for $480K, regardless of what's going on with them medically. So essentially, this person will max this out in 8 years. And at the end of that 8 years, go ahead and open up another policy, guaranteed, and be able to do the same thing on repeat without having to worry about not being able to qualify later down the line. Now, with this design, the cost of insurance is still $2,000, just like the 10-year option. However, with this policy on year one, they'll have $6,000 that they can take out of the policy. So again, we are still putting the same $12,000 every single year, but with this option, they can take out half of that on year one, in addition to having a guarantee of being able to get another policy later down the line without having to get an application in. And then on year five, $55,000 available to take out. Age 65, $305,000 available to take out. Now, this is not an exhaustive list of every single design that you can do with an IUL. These are just the most common three that I work with my clients, just based on where they're at. Over 40, looking to maximize their money, looking to have extra income down the line. By the way, link is in the comments to work with me. So if you're here, you probably filled out a form on Instagram or Facebook to get more information about an index universal life policy. But now you are wondering, how do I know if this person is actually legit? Is this a real life insurance agent or is this just a scam? Am I right? Put a little hands up emoji in the comments if I am correct. Now, it is extremely important for you to feel 100% confident that this person that you're dealing with is actually legit. Because if you are getting an index universal life policy, it is going to, well, if they are good, they're going to be asking you questions about your personal finances, your health, how much you make, how much you have saved, how much you're paying for your mortgage. All those things matter. And eventually, if you want to apply, you're going to have to give them your social security number and your bank account as well. So if at this point you're feeling like this person is not legit, don't waste their time and don't waste yours getting on a call until you feel 100% confident that this person is the person for you. I'm going to make 3 suggestions for what you can do to verify if this person is legit. But in the end, it is important for you to take a step back and ask yourself, why is it that you feel uncomfortable and what is it that you would want to see in order to feel good about this person? I'm curious what that is. Go ahead and drop that in the comments. Before we get into it, my name is Nobu Musakiwa. I was able to quit my 6-figure 9-to-5 and also pay off my house by asking real estate professionals very specific questions so I could make better decisions with my money. And now, as a licensed financial professional on this channel, I'm here to answer your questions so you can make the best decisions for yourself regarding cash value life insurance. The first thing that you want to get clear on is whether or not you are dealing with a life insurance agent or a life insurance broker. What kind of person you're dealing with is going to matter in order for you to verify whether or not they are in fact legit. Now, if you're dealing with somebody that is an agent, they work for a specific company. They may work, for example, for State Farm, and that is the only company that they can offer you products with. Versus if you're working with a broker can offer you products from multiple companies. They are not employed by a specific insurance company. They have contracts with multiple companies, and their job is to understand what is going on with you, what do you need, and then submit an application on your behalf with the appropriate insurance company based on what works for you. And so if you are working with an agent that is tied to a specific company, Well, it's very easy to determine whether or not they're legit because they're going to have an email that says at such and such company. So at Allstate, at State Farm. So that's an easy way to determine whether or not they are legit. You can also do a little bit more digging, which we're going to go over in a minute, where if somebody is a broker, they could be working under a company, or it could be that they're not. So just because they don't have an email that says at a specific insurance company does not mean that they're legit. I, for example, do not have an email that says at a specific company. I do have an email that's at my website address. However, most of the time, from dealing with brand new people, it's going to be from a Gmail account. Reason being, emails that come from a personal account get to email inboxes easier, as opposed to if it's from a company email, it's going to end up in promotions or spam. And so if I want to make sure that people that are interested in working with me actually get my emails, it's going to be coming from a Gmail account versus my actual company site. So just because somebody does not have an email that's at an insurance company does not mean that they're not legit. Whether somebody is an agent or a broker, in order for you to talk about life insurance product, you have to take a test, you have to be licensed, and you have to get what is called a national producer number. So what you want to do is ask the person you're working with, whether it's an agent or a broker, what is your national producer number? And they should be able to give you that number pretty easily. If you ask somebody for the NPN number or a national producer number and they have no idea what you're talking about, well, then you know that you're not working with somebody that is actually a licensed life insurance professional. Now, unfortunately, you cannot go ahead and look somebody up using just the NPN number. If you just search for that NPN number that they give you, most likely nothing is going to pop up from an official site. What happens is with that national producer number, that gives that individual the ability to now go and apply for a license in different states. So you can ask them for their license number. They probably are going to have to look it up, and that's totally fine. That is normal, because the reality is, especially if somebody is a broker, they have licenses across the whole country, and nobody's going to remember what their number is for every single state. So if they have to look it up, that is completely fine. And with that license number, you can now go to the NIPR site, which is one of the sites where insurance agents register to get this NPN number. With that license number for the particular state, you put in that license number, put in the state, and it's going to pop up and confirm the NPN number. When you look them up on an IPR, it should match the NPN number that they gave you. If it doesn't, then you want to go back to them and confirm, or you can keep it moving. Before we get into the next way of how to verify if a life insurance agent is legit, I am curious, what is it that you saw or heard from this person that made you feel like they were not legit? Go ahead and drop your thoughts in the comments. Let's run a competition to see who has the most crazy thing that happened. Whichever one you see that you think is the craziest or most interesting, go ahead and like that. And let's see who gets the most likes on this. And if you're still looking for someone to help you with an IUL, I will leave my link in the comments as well. So you can book an appointment with me. But of course, make sure you do all your research to make sure that I am legit before you book your appointment. This next one possibly might be the easiest, depending on how organized and simple your state is when it comes to providing public information. As I mentioned before, your NPN number is the national number that every single life insurance agent has. But in addition to that, there is a license number for every single state that somebody is licensed in. Sometimes the number in the state is the same as the NPN number, and sometimes it is different. So if you ask a life insurance agent for their license number, they could give you an NPN number, but that's not the actual license number. So again, like if you're hitting roadblocks, it doesn't necessarily mean that this person is legit. You may just be having some miscommunication. And so if you actually like this person and they seem normal, then it is okay to have a conversation and let them know, hey, here's what I'm looking up. Here's what I am looking at. How come I cannot find you? For example, if you look up Nobu Musakiwa, you are not going to find me. You need to look me up by my full name. Otherwise, I will not pop up in insurance databases. So if you like the person that you're talking to, have a conversation. It's kind of like dating and relationships. Nobody can read your mind if you don't tell them what you need. If you don't tell them what's going on, you might just be having a fight with yourself. In this case, you might just be missing an opportunity to work with somebody that could design a really great policy for you, but because you didn't communicate, you'll end up working with somebody that's gonna mess up your policy. Anyway, enough of that. Every single state has a Department of Insurance. So if somebody is talking about life insurance products, they need to get a license from the Department of Insurance. So if you Google Department of Insurance plus your state, hopefully the first thing that pops up is your government site for the DOI. On this site, you want to look for something that says look up insurance agent or look up a license. You should have something like that on that site. And on that site, you can go ahead and search for your insurance agent's name. And it should pop up on there and let you know whether they have a license, when they got it, if it's expired, all that jazz. Some states will also give you an option to call. A lot of states, a lot of organizations, a lot of companies just trying to get away from doing phone calls because it just takes up time. So don't plan on having the ability to call, but most certainly you can absolutely look it up online. Of course, that life insurance agent should also be able to produce an actual PDF copy of the license as well. But if you're in a place where you aren't feeling like you trust them, are you going to trust a PDF that they could also, doctor up? I always like to give clients the opportunity to go and do their own research on their own. So they come to their own conclusions on whether or not they want to work with me. And if they don't, perfectly fine. Because like I said, you're going to have trust with this person because you are going to have to talk about your finances, your health, give them your social, give them your bank account, give them your ID number. So if you do not feel 100% confident that this person is legit, then you don't want to work with them. And that's perfectly fine. Find the person that works for you. It's just like dating. You don't have to like everybody. You just have to find one person that you like that works for what you need. Now, every day I talk to people that are interested in getting an IUL, but there's this misunderstanding that anybody can get this account and you just have to say you want it. But the reality is it is one of the more difficult types of life insurances to get because there are so many benefits that come with it. My personal favorite is that I can grow my money to whatever amount I want. And as long as I access this money appropriately, the government can never tax it. That makes me excited. But there are 3 additional benefits to having an index universal life policy, and it is not what you have been hearing all over social. So go ahead and check out this video right here to get all the details on what that is. I will see you there.